Hello and welcome. I'm here today to introduce you to our investment outlook for 2026, which we call the role reversal. So why a role reversal in 2026? Well, for starters, we see the US's role as a growth leader being challenged. Tech investment is becoming increasingly dominant as the main engine of growth, while other key parts of the economy, such as the labor market and consumer spending, they remain fragile. Instead, we now see a coming together of growth rates in GDP and in profits across the Western economies. And that's also helped by European and Chinese policy support. Europe also faces the absence of the bad luck that it's had in the past, with many economies in the periphery now leading the pack. It's a role reversal compared to recent years and compared to the crisis that engulfed the continent 15 years ago. The global trade environment will also be challenging in 2026, but the fastest GDP growth will remain in Asia, in the Gulf, and in frontier economies. So especially areas like India, Indonesia, other parts of frontier. No big changes there. China remains committed to stabilizing its economy via a wide range of targeted stimulus measures, including fiscal support for consumers, while also prioritizing investment in technology-led industries. And China's also now a key player in the global AI boom, with Taiwan and Korea also benefiting from the formation of an AI-driven semiconductor supercycle. Meanwhile, India remains a star performer in the region, with government investment a key growth driver. The country's large, domestic-orientated economy, boosted by recent measures such as the GST rate rationalization, also helps to shield it from the global headwinds. Now, evidently, there are some risks for emerging markets in terms of how quickly China exits from deflation and in terms of global trade trends too, and whether or not this promise of strong growth forecasts is actually delivered. But importantly, we don't have a recession in the core global scenario. So although we've had some softening in short-term cyclical data during the fourth quarter, we think financial conditions and policy settings remain supportive as we head into 2026. And that helps to secure the growth outlook. The other good news is that policy uncertainty measures today are falling right back. Tariffs are much less topical for investors, and regional trade integration is helping to offset weaker trade with the United States. And so the questions for investors are a bit more about profits uncertainty, or the AI bubble uncertainty, and about uncertainties surrounding monetary and fiscal policy. In terms of the Fed, sticky inflation is a challenge, as supply-side constraints mean growth is likely to come with higher inflation. We think that will keep some FOMC members a bit hawkish, but another few cuts in 2026 look achievable to help insulate the labor market, with a similar easing process likely to come from the European central banks. And we should also see some cuts from emerging markets too, although in general we think it will be more a case of emerging markets following the Fed. And that's a role reversal versus what we've seen in 2025, where generally emerging markets and European central banks have been leading the Fed. So we think this shifting global macro and policy backdrop is consistent with changing characteristics of key asset classes and a change in the part that those asset classes play in our investment portfolios as well. Emerging markets, for example, now look structurally safer and less volatile than they have done in the past, thanks to the efforts to de-risk the economies and to improve policy frameworks. And at the same time, the opposite is true for US asset classes. Amid increasing concentration risk, deteriorating institutional quality, it's clear that many investors are revisiting their assumptions about how much weight to place in bonds or stocks in the United States. And for international investors, how much dollar currency to hedge as well. These are new issues for investors to grapple with. And in 2026, we also expect a role reversal in market drivers. A lot of this year's strong performance in international stocks and in emerging markets has been about repricing and improving sentiment. That means that PE multiples have moved higher, or credit spreads have gone to multi-decade lows. And it's also been about the dollar. But with valuations no longer such a tailwind, and further big falls in the dollar certainly not guaranteed, the role reversal is that profits and credit fundamentals need to stay good to deliver strong returns again in 2026.
投资一定有风险，基金投资有赚有赔，申购前请详阅公开说明书。